Hello, everybody, and welcome into Commodity Culture, where our goal is to make you a better investor in the commodities sector. My name is Jesse Day. Before we dive in, standard disclaimer, nothing here is investment advice. Do your own due diligence. And today's guest is the growth manager of OneGold at APMEX, a trusted source for precious metals. And the OneGold platform makes buying, selling, and vaulting physical gold easy and safe. We're going to discuss the gold and silver markets today, of course, in the aftermath of Liberation Day. A lot going on both in the world and financial markets. So I'm very happy to welcome Levi Gunter to the show to break it all down. Great to have you back.
Great to be here. Thanks for having me on, Jesse.
Absolutely. Let's kick things off with the aftermath of Liberation Day. You know, it seems to be a trade war that is getting hotter with China, tariffs just going up to incredible levels. There are, however, some discussions about potential negotiations. So we'll have to see how it all plays out. But nonetheless, I've spoken to a lot of people who think this has fundamentally changed a lot of aspects of the global economy. I'm wondering what your thoughts are on its effects both on the economy and financial markets as well.
Yeah, well, there's a lot to unpack there, right? And I think for me, amidst all of the kind of chaos that we're seeing, I have to almost remind myself and sort of state the obvious, which is that the president uses or likes to use tariffs as sort of a cudgel to achieve a variety of means, depending on who you're negotiating with, right? And I almost kind of separate the sort of 185 countries that we've tariffed on Liberation Day with kind of the actual like full-blown trade war that we're now in with China. I think those are almost two different scenarios in some ways. And for the non-Chinese tariffs, if you will, I think we almost have a blueprint for how that could play out just based off of what occurred with our North American trading partners, right? So initially, it was announced with Canada and Mexico, we were going to levy, I think it was a 25% tariff. And of course, the president wanted more cooperation on the border and maybe cooperation in terms of curtailing the flow of fentanyl. And of course, he achieved some concessions there, and subsequently, the tariffs were ratcheted back, right? And I think you're kind of seeing that play out with a lot of these other countries right now with the whole 90-day pause. I almost view that as just more of a negotiating period, if you will. And so, yeah, we'll see how that plays out. And then there's the Chinese scenario, right? And I've heard this compared to like a game of musical chairs where you don't want to be the last one standing when you're negotiating with the U.S. because ultimately you're going to lose leverage, right? And I don't really think, it's not clear to me that the Chinese really actually view it that way. And it doesn't seem to me that they're really wanting to make concessions at this point. And, they have a variety of levers that they can pull as well and have already. I know they've started to withhold rare earths and minerals that are used in a variety of commercial and military capacities. So that's something they could, dump U.S. treasuries even, which would be risky for both economies. This is just not something we've seen in quite some time, if ever, where you have the two largest economies that are intertangled economically now going at each other in a full-blown trade war. And by the way, neither one has blinked yet. And from the U.S. perspective, this could work out fantastically, or it could actually backfire, right? And so as that kind of pertains to the markets, this has really just created a lot of something that markets really hate, which is uncertainty. And I don't think that is going away anytime soon. Obviously, we're in that negotiation period with all the other nations at this point. But as far as the Chinese trade war is concerned, neither country's blinking. And I think you're going to see, continued volatility. I know it's a broad stroke statement, but in the equities markets and the bond markets and even in precious metals.
Yeah, great breakdown there. I want to talk about precious metals now because we've seen the broad market and the US dollar take quite a hit in the aftermath, but gold making all-time highs once again and being one of the few assets that held up very well in the heart of the storm when the tariffs were getting announced. Do you think we're starting to see the beginning of a rotation from overpriced tech stocks and fiat currency and the US dollar into gold? And in that sense, could we potentially be witnessing the start of a monetary regime change?
Interesting question. To me, the whole kind of tech stock meltdown, if you will, started probably in late January, right, where DeepSeek AI was unveiled, and I think that kind of sparked some concern or just questions really about, hey, maybe we could actually get AI infrastructure cheaper than what maybe, for example, a NVIDIA could offer. And so I think it started then, and I think certainly there is sort of a rotation from certain overpriced assets. And look, I'm a gold dealer. I would really love to come on here and say, yes, this is a massive monetary shift, and people are going away long term from fiat and other assets and into gold. Rather, I think it is more so a natural cyclical kind of shift in sentiment from risk on rather to risk off.
Yeah, that does make a lot of sense. So in that scenario, gold will obviously benefit, seeing as it has no counterparty risk. And it seems like both the treasury market is under pressure as well as the broad market. I want to shift to silver now because it was nearing $35 an ounce pre-Liberation Day, took a dive below $30 after the tariff announcement. I think perhaps showing that it is more of a volatile and speculative asset than gold, and perhaps has lost some of its shine as a monetary metal. I wonder what your thoughts are there. Is that what you see, and how do you expect silver to perform up ahead?
It falls in line with expectations, honestly. Gold and silver, neither are immune to sell off. So we saw that in 2020 and to a much lesser degree now. And gold has obviously recovered and is at or near all-time highs as we're speaking. And silver is lagging, as it often does. As we know, your audience knows, gold and silver carry a really high correlation coefficient, meaning they tend to fall and rise almost in tandem. But silver does tend to lag gold. And I again, totally within the norm and kind of what I would have expected to see. To me, I'm looking at the opportunity in silver right now, and it looks like a buy, because this has only happened maybe a couple times over the last 25 years when the gold to silver ratio is at or near $100, right? And so it does, to me, seem like a near-term buying opportunity for silver. I don't necessarily know if I see silver outshining gold for the rest of the year. I think in my forecast, I've got gold up, for the entire year about 30%, which is about 38, or rather 34.50, and silver around 38.50, which would be about a 26% ish gain for silver for the entire year. And so I think that dynamic will continue to play out where they rise and fall in tandem. And I think for me, for silver to kind of outshine gold, and I've been asking this question for the past like several years and continue to now, is like, when is that other shoe going to drop for silver? And that physical silver deficit that we've seen, over the last 4 years, and will probably continue into 2025. That to me is something that I'm looking at, and the cumulative silver deficit is somewhere in between 750 and 800 million ounces. And just to kind of put that into context, we produce about 1 billion ounces of silver each year. So eventually, I think that other shoe may fall for silver. When that is, I don't know. But long term, I'm bullish on the metal, just given that really favorable supply and demand dynamic.
Last time I had you on the show, we discussed how geopolitical risk was a major driver of the gold price. It's a factor I think continues to play a role. The war in Ukraine showing no signs of slowing down. Trump has bombed the Houthis and is threatening Iran. We could see a new hot war there. Israel-Palestine continues to rage. The list goes on. A lot of conflicts people aren't paying attention to as well. How do you see these conflicts playing a role up ahead in gold and silver markets? Do you expect it to continue to drive that safe haven demand? In other words, a world in chaos is one where you want to hold an asset with no counterparty risk in your hands?
Exactly. I do, at least, I would say for the rest of the year, if I had to guess. As you know, gold's hit its most kind of notable all-time highs at the onset of all of these conflicts, where it was Russia, Ukraine, Israel and Hamas, and then, the direct exchanges between Iran and Israel. And so that's been a key driver of gold over the past 4 years, 3 years. And I think it will continue to be. And it is chaotic. There are a lot of parties involved. And to me, I try to simplify it as much as I can and just look at, hey, who's negotiating with who? So obviously there's a lot going on in the Middle East, right? But really it boils down to the United States and Israel's negotiations with Iran, because they control a lot of these proxy groups. You mentioned the Houthis, and then obviously in Russia, it's about United States and Ukraine's negotiations with Russia. And then there are also tensions, as we all know, between the United States and China as it pertains to Taiwan. So when I take a step back, it's like the U.S. is negotiating with Russia, the Chinese, and Iran. And to me, none of these counterparts, if you will, are really showing signs of immediate concessions, although I am encouraged. It seems like negotiations were at least open to that at this point. I've even heard, rumblings of direct or indirect negotiations between the United States and Iran, which would be a positive development. But all that to say is that's a slow go. And I don't think these things are going to wind down over the course of the next couple of months. So to answer your question, I know it's long-winded, but I do feel that all of those conflicts really and potential conflicts are going to persist as gold drivers, at least throughout the rest of the year.
Yeah, and a lot of tension in the EU as well, as we're starting to see calls for military conscription, an increase of military budgets, which will require taking on more debt, which I think is also positive for gold in the long run. I wonder if you have any thoughts on the potential for gold revaluation. This is a topic that's being floated out there. A lot of people are convinced that the Trump administration is going to move forward with some type of gold revaluation, as gold is currently $42.22 on the Fed's balance sheet. Is such a move feasible? And would it solve any problems? Would it create any problems? How would you view a scenario where gold is revalued, let's say mark to market?
That's yeah. There's a lot to unpack there, and really, I don't know, to be honest with you. I think that a lot of times governments act in their own interest, and certainly if it's in the government's interest to have a revaluation of gold and are looking at effects on the balance sheet, maybe they will pursue something like this. A lot of this, I think, can be kind of a result of the rumor mill, but yeah, far be it from me to kind of opine on that, because I'm not sure what their intentions are, and yeah, I'll kind of leave it at that because I'm just not sure.
Well, I want to talk about the outflows of both gold and silver from the LBMA. This has been quite a topic of discussion on this program. I've had a variety of people come on the show and discuss it. Ed Steer, Mario Ineco, Andy Scheckman. The list kind of goes on. I'm wondering what you're seeing there, because it's tough sometimes to separate hyperbole from fact, because there's always that story about, oh my God, the LBMA is getting drained, or very often it's the COMEX is getting drained. We're going to break the paper manipulation. Gold and silver is going to go to the moon, et cetera, et cetera. We've all heard all these stories. I wonder what you're seeing when it comes to the outflows and the inventory levels at the LBMA for both gold and silver.
Yeah, really good question. So, as it pertains to the retail front, the whole tariff situation and onshoring of gold, that's been an interesting and evolving situation, right? So, just to kind of zoom out, to kind of paint the picture, as the year started, the theme was buybacks, right? Customers were liquidating metal at a really high rate. They were taking profits, which is always nice to see. But to kind of put that in a little more context, if you take our basically buyback revenue at APMEX as a percentage of sales revenue, that was elevated at the beginning of the year. It was around 35%. In a normal year, maybe 2024, that would have been closer to 15, 20%. And I even heard rumors of certain authorized purchasers of the U.S. Mint just turning down their allocation. So there was a posture at that point of, hey, there's just a lot of inventory. We don't necessarily know what to do with it other than we're going to discount premiums. So you saw premiums drop, and you sort of saw that shift, and it shifted when tariffs were announced. And obviously you mentioned the outflows from the LBMA and the onshoring of a lot of metal. And really what dealers were doing then and are sort of still doing now is strategically positioning themselves in a way that they can account for tariffs and also serve their customers at the same time. And there's a lot to account for. For example, think about 80% of our U.S. silver grain comes from abroad. A lot of that comes from Mexico. And while tariffs wouldn't necessarily have a direct impact on spot price, it would certainly have an impact on premiums, right? And so there's a lot to account for there if you're coming from the dealer perspective. Luckily, our current understanding of tariffs is that bullion is actually excluded. Now, there's sort of a legal question there, which is like, what is bullion? And so, bullion could be just wholesale products. Is something like a gold American Eagle considered bullion in this cutout? So these are things that we're certainly like actually engaged with our legal team, trying to gain clarity on, while making sure, the inventory is in a right way where we could, continue to service our customers.
And so, what are the concerns that you're looking out for, as much as you can speak on, when you talk to a legal team regarding the tariffs and kind of just the uncertainty? Because it seems like the Trump administration has a plan, but that plan often involves pivoting. Some speculate that it was the reaction of the bond and the stock market that kind of spooked the Trump administration into reversing course on tariffs. So how do you navigate that as a gold and silver dealer? What are the challenges you're looking to avoid, and how do you mitigate that potential risk?
Yeah, so there's a lot to consider, and you can't go off the assumption that we'll ultimately pivot, right? Because while that may likely be the case in a lot of scenarios, you can't, as a business, say, well, don't worry about the tariffs; they're gonna, not ultimately take effect. And so what you're really looking at is the cost of bringing in metal from a variety of mints, a variety of other wholesalers, and the cost associated with that, which is now may vary. And how does that work into your model and your pricing where you actually sell metal? And how do you keep inventory on hand to a point where you're not carrying too much, but you have enough to satisfy current demand, all while demand is fluctuating? So there are a million different moving pieces, and it does seem to me that we're going to have a little respite from that because of the bullion cutout, and it almost seems like a lot of these products will be actually exempt from tariffs, but something that you really want to confirm first and kind of go from there.
Yeah, absolutely. Let's talk about central bank gold purchases continuing to be a driver for the market. Have you been watching which central banks are stacking gold recently, and what does that data tell you about developments in the gold market?
Yeah, I've been watching. I've been watching for a while. I'm kind of fascinated with that, as I'm sure a lot of people are, just because really central bank demand accounts for so much of gold's total demand. It's like a quarter of gold's total global demand comes from central banks. And so, as your audience probably knows this as well, central banks have been buying at quite the pace since 2022. I think at least 1,000 metric tons each year have been purchased collectively by central banks. And even more recently, in Q4 of the last calendar year, central banks bought about 330 tons of gold, which was up from the last Q4 of the prior year by 54%. So they're actually kind of doubling down at this point. And I think you asked like who is leading the charge there. And looking at the last quarter, it looked like purchases were led by, I believe, Poland, India, China, and Turkey. And so you're looking at these countries, and obviously a lot of them are located in places where geopolitical tensions are running hot. But you don't really have to play the guessing game as to why they're buying metal, because they'll tell you. The World Gold Council actually surveys all central banks as to why they're buying gold, and I find the reasons interesting. They've been the same for almost a year now, and in that, in no particular order, the top three reasons tend to be central banks are buying gold due to its hedge against inflation, right? Due to its performance during times in crisis, and due to its use as a portfolio diversifier. So its gold is obviously carries a low or even negative correlation with bonds or currencies like the US dollar. So there's some de-dollarization at play there as well. So a lot of purchases coming from central banks, and the reasons, to me, spell out that central banks still see inflation as a continued risk. They anticipate some uncertainty in the markets, and they're preparing for that. And interestingly enough, those are a lot of the same reasons that retail investors buy gold as well.
Do you pay attention to the gold and silver mining space at all? And if so, are you watching the divergence here? Because we've seen kind of normally when gold enters a bull market like it is in now, the mining stocks act as kind of a leveraged play on gold. And a lot of people I've spoken to have said this is the first time historically that actually the metal is led and the miners have lagged. The big valuation gap, although we are now seeing the gold mining sector start to wake up. Do you have any thoughts on that?
Yeah, I think it's interesting situation. The valuation gap. Miners face a lot of headwinds that just the price of gold does not. In this inflationary environment that we're in, you've got to consider things like operating costs, fuel costs, legislation, and so there are just a lot of headwinds that are kind of hard to sort of parse out if you're looking to invest in a miner. And I think probably, just this is just kind of me anecdotally speaking, so take it for what it is. I think there's probably a little bit of investor hesitation there too, right? Clearly gold's gone on a good run. That's a simple way to get exposure. And you've got to pick the right miner. And you look at data. I'm thinking maybe to the one of the last big bull cycles for gold was, what was it, 2008 to 2011. Gold went from about $900 to $1,900 an ounce. Folks piled into, especially the junior miners, and gold does what it does often, and it retraced those gains over the last 5 years or the next 4 years and lost about 45%. And a lot of junior miners lost about 80 to 90% of their value. So there can be some incredible upside to some of these investments. It's just a matter of picking the right one. And in order to do that, you really have to have a firm understanding of, the company, the management team, what their outlook is, what their headwinds may be. There's a lot that comes into play there, and you have to do things like read 10Ks and 10Qs and things that I don't do on a regular basis. So I guess the short answer to your question would be, yeah, I'm sure there are opportunities there. It's just a matter of, finding the right one.
Yeah, that's a great way of breaking it down because there's a tremendous amount of work involved in picking individual mining equities. Mining is an extraordinarily tough business. I always point to the uranium industry, like there's only two big producing mines, and even Kazakhstan, the world's largest producer, is facing massive problems right now. They're missing production guidance, shortage of sulfuric acid. We're seeing all sorts of projects that are in the development stage ramping up to production getting halted or getting delayed by a coup in Niger, which literally took more than one uranium company completely out of the region, and is severely delayed others, down to not having enough of the right personnel, down to engineering problems. I mean, the list goes on. Mining's tough. So you really got to be willing to put in the time and build that knowledge up. Now, heading back to the physical world of gold and silver, talk to us about what you're seeing at APMEX as a precious metals dealer in terms of retail buying of physical gold and silver. How is it comparing so far in 2025 to other years? And then if you could talk to us about the advantages of purchasing bullion through APMEX, that would be great too.
Yeah, so we've seen a bit of a shift, right? I think I mentioned it earlier where at the beginning of the year, there was a lot of profit taking. And so buybacks were kind of the theme. And when tariffs were announced and there was some broader market volatility, we've really seen sales pick up. And I'm referencing APMEX and in OneGold as well. If I'm looking at sales over the past month, we're about 45% higher. Actually, the last full month, so about 45% higher in March than we were in February. And April is trending to be better than even March will be. Or than March was. So sales, we've kind of seen that shift in dynamic from customers selling to customers buying. And it seems to me they're really favoring gold at this point. So, to use round numbers, it's about a 60-40 gold to silver split as far as what they're selling on APMEX. And I even see that reflected in the ETFs as well. I like to track the ETFs. So looking just year to date on the largest ETFs, the GLD has added, I think, about 9% in gold AUM, and at the same time has lost about 3% in silver AUM. So a little bit of a divergence there, despite, I think that silver may be a good opportunity right now. So yeah, that's kind of the overall trend at APMEX. As far as the advantages of APMEX, look, there are a lot of dealers out there and a lot of dealers that are going to do exactly what APMEX does, in that you pay them and they send you the metal. But really what the most important thing in my mind as an end user is that I'm dealing with a reputable company that's going to take care of me. And APMEX is not probably one of the most, if not the most reputable companies out there. It's the largest, physical retailer here in the US. They've been in business for, over 25 years now. They have over 2 million customers. So that trust aspect is key. And also, like, depends on what you're investing in. If you're more of a numismatic person, or semi-numismatic, or if you just want bullion, you want a selection. APMEX offers that in spades. They've got like 30,000, different products there for you on their website. And there's an advantage there to actually being able to talk to somebody, right? Because maybe you're unsure about, do I buy a random year silver American Eagle or a current date, or does it matter? Look, you can call them and they'll walk you through that, and they'll help place your order, and they'll help you on your exit strategy too. And when it comes time to liquidate, it's really easy to do through APMEX. So all that to say, not a sales pitch for APMEX, but as an end user, I like to look at those things. Are they trustworthy? Do they have what I need? And are they going to take care of me? And APMEX certainly checks all those boxes.
Talk to us about the OneGold platform and how it can be used alongside physical self-custody of gold and silver in somebody's stacking strategy.
Yeah, I think you kind of hit it in your question there. As OneGold is kind of a complement and to physical possession. And at OneGold, we like to talk to our customers. We like to survey our customers. And what we've learned is about 75% of our customers on OneGold actually owned or have owned physical precious metals. And then when we ask them, well, then why are you, engaging with OneGold? What's got you interested there? Really, it boils down to a few things. They obviously view OneGold as sort of a complement to their physical holdings because you get more metal for your money on OneGold. You can buy gold and silver at or near spot, so you just get more metal there. So that's one piece of it. The other piece is the security aspect, right? So a lot of our customers, they put 6 and 7 figures into gold and silver. And at a certain point, that becomes an untenable risk in your house or even in your bank deposit box because it's not insured. And so with OneGold, it's insured. We actually use a company called Lloyd's of London. It's audited. And so a lot of our customers who are investing, these types of amounts or otherwise uncomfortable holding metal in their home or investing in ETF, they view OneGold as kind of the safer option. And it's just also intuitive. This is one thing that comes out in surveys is, they enjoy the ease of use, especially as it pertains to liquidity. I mentioned the exit strategy earlier. I don't really want to have to call multiple dealers to sell my metal. I've done it before. I don't really want to have to ship metal. I've done that before. And with OneGold, you just do that in a few clicks. And again, not a sales pitch for OneGold. That's just kind of what we tend to hear from our customers.
And could you remind us where the metal is actually stored?
Yeah, we offer a variety of storage options at OneGold. So you could store here in the US, you could store in Canada with the Royal Canadian Mint, or at vaults in the United Kingdom or Switzerland.
Great. Well, Levi, this has been a fantastic conversation. As always, I really appreciate you sharing your knowledge with the audience. I'm going to put a link below to both APMEX and OneGold for people who want to check those platforms out. And it's been a blast. Looking forward to talking to you again in the future.
Likewise. Thank you so much.
Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.